Okay, folks, we're going to be looking at how traders make 10% per month. And we're going to stick with our theme here using our case study on the Aussie dollar. Now, quickly, obviously going through everything we've gone through in the previous two sessions. We've identified a 75-12 level on a daily chart. We brought that down into a hourly chart. We noticed that there was buy stops above us, so we know that there's liquidity pools resting above those specific highs. So the market should be reaching up there as much as 100 pips from the level we're identifying, 75.12. So very easily get up to 76.12. Looking at the 15-minute time frame, as we've shown earlier in this series, we've shown that there was a buy set up at 75.12 on the daily chart. We had a old low. Everything that we referred to and what to focus on in September, everything is being identified in this specific case study. We don't really require the market to give us an hourly setup to get in and use that risk. We can use a 15-minute time frame and use the framework that price gives us on that specific time frame relative to what you see on the 15-minute time frame. Obviously, the risk can be reduced from what would be seen on an hourly chart, and then just as well, the 15-minute chart can be reduced down into a 5-minute chart, and we identified where the stop could be in relative terms to the bullish order block. And we also framed out where 3-to-1 reward to risk ratios would unfold, and it happened to be right below our first area of buy stops, or the 5-minute liquidity pool. Now, this is nowhere near the level of the objectives we identified, just framing the trade on an hourly chart. I'm just giving you the context. What if we were to look at the market like this and say we traded this particular pair and we had a 2% risk on the trade? If we had 2% on the trade and the market trades up to this high where the buy stops are, that's a liquidity pool, the market should respond off of that 75.12 level because it's a daily chart reference point or bullish order block. If we take our 2% position and take half of that position off as we get 3-to-1, notice it doesn't have to even blow out the buy stops here. These buy stops don't even have to get blown out. This is 3-to-1 reward to risk. So we can take first profit and bank a 1% times 3R. So we can make 3% on this one trade here and still leave the second portion of the trade on, aiming for what? Those liquidity pools referenced on the hourly chart. Now, as price explodes and goes through those buy stops, obviously you can see going up to a 15-minute time frame, now we can go and look at higher liquidity pools, reaching into higher and higher grade liquidity pools until we get to that hourly chart. But for right now, just simply look at what's already happened. The framework we used for the 5-minute chart that we've outlined in the second session, that model on risk allows us to have 1, 2, 3, 4, 5, 6, 7, 8, 9 R. In other words, we made $9 for every $1 risk, just reaching into the 15-minute buy stop liquidity pool. The liquidity pools that we saw on the hourly chart, that's what's being identified for our objectives. But now here we have a crossroads. You know, can we take some of the position off here, or do we leave the second balance of the original position of 2%? We only have 1% remaining on. We could take a portion of that off or we can leave it to go higher and reach for those higher objectives. The choice is going to be yours. Preferably, I think I would like to take something off because we're in a really nice liquidity pool relative to the 15-minute time frame, and we might get some consolidation, or could be wrong, could even reverse here. We don't ever know that. But we are trading with higher level institutional order flow relative to that daily order block from 75.12. We've seen expansion on the upside. It's now taken buy stops in the form of a liquidity pool in the 5-minute chart we just shown. Then now we see the 15-minute liquidity pool in the buy stops over here. That's been violated. So we've already seen 9-to-1 payout, which is astonishing by any measure. And then letting the price go a little bit further, once we clear this buy stop, the area over here would be reached into as well. And we'd have 15R as well. Now this is the liquidity pool that we're resting around that same hourly basis. I'm just viewing it in terms of the 15-minute chart. You can see the expansion that's available to you when you look at the market, framing it with very low risk. Very low risk. Now, notice also, we took first profit at a multiple of 3-to-1. So we made $3 for our $1 risk. As soon as we did that, we've already made 3% on the trade with ultra short-term risk, less than 10 pips. That was it, less than 10 pips. But let's just say we framed the trade with a little bit more than that. Say we used a little bit more comfortable stop. Say it was a 20-pip stop. Could that still pay out in handsome rewards? Why wouldn't it? Obviously, the market reaches above the stops. We know that the market reaches for 10 and 20 pip grades for stop sweeping. We have the old high back here. And price just gets real close to it, but expands right above where we would expect to see price reach for. Here's what I want you to focus. The potential range was about 100 pips from where we were looking at buying and where we thought the price was going to go. We don't need the absolute high and we don't need the absolute low. We're looking at the lion's portion of the move, about 100 pips. Let me ask you a question. Do you think you'll get every pip of every potential range you identify as potential profit? If you're insisting on it, you're going to be frustrated. But you don't need that. What happens if you just had half of the range? Would you be disappointed? If you say yes, you would be disappointed. My question is why would you be disappointed? Is that better than what you're doing now? As a new trader, it's probably going to be very easy for you to say, well, that would be better than I'm currently doing now. Let's look at some numbers. Assume for a moment we had a $1,000 trading account, and we set the trade up originally as we did with the 5-minute chart, less than 10 pips. We're going to say we rounded it to a 10 pip stop loss. And the market came up and allowed us to get our 3-to-1 multiple. In this trade, we would already have 3% paid to us. Now, we're going to assume that you've gone through the mentorship, you've learned how to do this, and you've gone to the point where you are comfortable trading with live funds. Or maybe you're still in the demo account. If that choice is yours, you have to make the decision in timing for your own sake. I can't do that for you. But say, for instance, you're looking at the trade and it's framed just like we're outlining it here. And it allows you to get a 2% position on. In other words, the trade is 2% risk. If you have the opportunity to get 3-to-1 paid out and you take that off your position, now you have 1% remaining. The first 1% taken off with a multiple of 3-to-1, you'd be taking profits at 30 pips. You've already banked 3%. Look what that does in a month. By itself, it's over 10%. So even if that's all you get is the first profit objective of 3-to-1. So if you frame your trades with really small risk, it's easy to get multiples of 3-to-1 or more for your reward. So your R levels are easy to get to when you start refining your risk. See, it's not having big risk that makes the money. It's having the small risk that makes the money. That's the real secret. The fact that you need to be able to frame your trades on levels that should see institutional sponsorship. That means should the banks propel price higher or lower because it's off a daily chart or weekly chart or monthly chart. Those levels are going to be highly impactful in terms of price action. They're going to drive price higher and lower relative to those levels because that's where the real orders are. It has nothing to do with your indicators. It has nothing to do with your supply and demand or your theory on price. It has nothing to do with that. It's where the orders are. And the orders are going to be around monthly, weekly, and daily levels. Now, what if you let the portion of that second half go and you only got half of that 100 pip range? Remember, we were looking at that setup. It was potentially 100 pips available to you. But say you only let it go 50 pips and you just couldn't bear to hold on to it, and that's all you could do. Or you did something that got you stopped out early. Okay, you trailed your stop up too aggressively, and you only managed to make 50 pips out of that. Now, this is assuming you've already taken that first 1% off. This is the second 1% that's remaining on the trade. By itself, if you collapse at 50% of that 100 pip range we were looking at, you're tacking on another 21+% for the month. If that's all you're doing week after week, if you're getting scenarios like this, one trade, you're focusing in tightly, watching one setup, and you are milking it for everything that it's worth, keeping the risk small and looking for higher time frame objectives. If you do that, you're looking at 21+%, what it's going to call 21, plus your original 3% on the first half of that trade. So really, what are you making? And you didn't even get the entire 100 pip range. Now think about that. We used the same scenario where we used a 10 pip stop and we let the second portion run after 3-to-1 was taken off at 30 pips. Then we let the remaining portion run and say we only managed to get half of that 100 pip range. Who would be upset? Would you be upset with that? I don't think you should. If you are, it's greed. You can't allow greed to do this to you. Now, what happens if you get the entire 100 pip range? Say you get your 100 pip takedown. No, one shot, one kill. You get it for the entire week. The second portion of that trade nets you over 46%. That's in 1 month, okay? If you let this continuously pan out and you do this every single week and you're looking for one shot, one kill scenarios and you get 100 pip objectives taken down on the second portion of your trade, remember, you're already taking partials off at 3-to-1. So you're taking 1% off. If every trade you take is 2%, once you know what you're doing, you scale off 1% at 3-to-1, and you wait for the second portion to reach for these higher time frame objectives. That's how you make a lot of money. You pay yourself initially, get paid, pay the trader. Take partials. Don't listen to people that don't make money. You have to pay yourself because you don't know if your trade's going to pan out. But once you get 3-to-1, you're already living in an environment that pays exceedingly well. Think about that. If that's all you managed to do is get first objective at 3-to-1, and it's all you ever did, nothing ever panned out beyond that, who would be complaining about that? Only folks that are demanding precision beyond your personal efficiency right now. You can't do it. You don't have that level of efficiency yet. You can grow into that over time, but you have to allow that time to take place. But if you get these one-shot, one kills where you're looking for a nice weekly trade of a 100 pip range, you don't need the 100 pip range to pay you out handsomely. But if you go in aiming for it, once in a while, you'll hit it. And we'll just play devil's advocate for a moment. And again, we're going to assume for a moment you did. You're able to take down 100 pips a week. It may require you to do another trade to pan out to get to that 100 pips. I'm not telling you to force yourself to get 100 pips every week, but it may require you to do a second trade or a third trade. Or you may take another trade and it reduces you down to just this. You can lose. You're going to have encountered barriers like everyone else does in trading. But if you're making your second portion of your trade pan out and you're reaching for higher time frame objectives, like we just framed with this trade, a low risk trade that's been framed on a higher time frame premise with the things that I taught you to focus on the month of September's content, the second portion of the trade will always make more than the first. Obviously, you're getting out early with a partial. But the partial is not a weakness. It's not an impediment to you making more money. when traders or educators or other folks say that you're taking off some of the trade before it gets to a profit objective that you've had in mind beforehand, that's coming from someone that does not make money consistently. And I'm telling you, because they're forcing themselves to hold on for their ultimate objective, and they're too black and white. In profit taking, you have to pay yourself when it's available. If you're binary, it's all or nothing, you're never going to be as good as you think you are. Believe me, I'm very proficient with price action, but I don't demand everything all off at my profit objective, my higher end profit objective. I've learned to pay myself, because there's many times I've had really handsome profits sitting in a trade, but I did not allow myself to take something off, and I watched it come all the way back and turn into a loser, or come back and take me out with a modest stop loss and then run in my favor, which is very frustrating, and you've probably encountered that yourself. But let's say, for instance, you couldn't manage to do that trade with 10 pips, and you were just stuck to that 1 hour setup. No problem. No problem. There's no reason to be upset about that. If you allow that 20 pip setup to give you a 50 pip run, okay, think about this. If you take the first portion of that trade off and you only get 50 more pips beyond it, in other words, you've placed your trade on and you paid yourself a modest 30 pips, moved to the sidelines, and then you only managed to get another 50 pips. Well, you made over 10% right there on the second portion of the trade. Think about that. It's not about how many perfect exits and entries you get, because this is after your first profit. You pay yourself something and then let the partial run. The balance has to run, and that will always pay you more. And here's the thing, the psychological effects of it not being a trade that's already paid you. You've taken some skin off of it, and that's good, because you have 1 pound of flesh now, okay, for your time, your energy, and your focus in that marketplace. When you focus on trading like that, 10% in 1 month on the back end of your trade, that's not just, we've already factored in counting the first portion of your trade. That goes without saying. That leads to 12% by itself. But if you can't do these ultra short-term trades, you can still do trades like this, and that's still handsome. 10% compounded over the year is over 300% for the year, and that's amazing. Where else are you going to get 300% return? There's no money manager out there going to raise his hand and say, "I'll do that for you." There's no fund manager who's going to say, "Hey, look, I'll double your money in a year. I can consistently do that. I'm going to work hard to do that." They're not working hard for your money. Okay, they're doing very little. They're very lazy, and you're going to watch your money better than anybody else. So when you see things like this, it's real important you focus on that number. Is an astonishing number. You can do very, very well with tripling your money every single year. 10% a month compounded does that.